Unpopular opinion, what if interest rates stay higher for longer? What would the implications be? What should you do in your financial life? I've got that and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up. Been a certified financial planner for almost 20 years and on just an incredible team of financial professionals, about 80 CFPs or CPAs or insurance or tax professionals on our team. And of the financial planners, we've got about 20 that are CFPs themselves. And I've been doing this for 20 years. And up until, a year ago, it's sort of been this, at least with interest rates, it's sort of been this expectation that, well, rates can't go any lower. Rates can't go any lower. My first house, and we all have these stories, my mortgage was 6.1%. And I remember Kevin Korhorn, founder of Korhorn Financial Group, saying, oh, that's a fantastic rate, right? Because at the time, and in comparison to where things were 10 years prior to that or 20 years prior to that, oh, that was a fantastic rate. And interest rates can't get any lower. And as they went down to 5, refinance. Well, they can't get any lower. So they went down to 4, refinanced. And so as interest rates over the preceding 40 years continued to get lower and lower, at least the thought was, well, rates can't stay low forever. They didn't. We printed a whole bunch of money. The Federal Reserve said it wasn't going to create inflation. They lied. They then were behind the 8 ball. They were late. They denied it. And here we are with inflation. We've had soaring interest rates for a long time. There's going to be big consequences. But I think that there's possibly an outcome that no one really wants. And I'm not predicting, and I certainly don't want it. But there's this thought that, well, rates were so low for so long. Well, yeah, we've had this little inflationary spike and interest rates. Oh, yeah, okay. I guess they've had to go up, but they'll come back down. They'll come back down. And what if that for 20 years of, interest rates can't stay low forever. They're going to go up at some point. What if that take is being replaced by the, interest rates can't stay this high forever. They'll come back down to where they were, right? Right? Well, what if that doesn't happen? Or what if they stay higher for longer? Now, I'm not suggesting that's absolutely going to happen. I can see the scenario or the chain of events where that may occur. And if that's possible, just like it was possible back when we didn't think rates could go any lower, that they continued to go lower, if it's possible, well, what will the consequences be financially, and how can you maybe not prepare as if, this is going to happen, so I need to put all my eggs in one basket here, but what could you be aware of, or at least be planful of, in case that is the outcome? Well, if interest rates stay higher for longer, the first thought that I have is the housing market. And we haven't seen, the real estate market has certainly plateaued, and in certain areas it has started to cool off. We haven't seen what many people expected from the very beginning, and that is, oh my goodness, mortgage rates at 6%, 7%, the housing market is absolutely going to is going to plummet. We have not seen that because of the laws of economics, supply and demand. Because interest rates right now are still over 7% on new 30-year mortgages, if you look at all interest rates out there, 90% of current mortgages are below 5%. People aren't interested in exchanging their 4% mortgage for a new 7.5% mortgage. There were just a handful of us that were talking about this potential outcome. We were one of them saying, guys, I don't think there's going to be a lot of movement in the housing market with interest rates at this level. And what that means is if there aren't a lot of people looking to move, then there aren't a lot of houses on the market. And when you have a limited supply and still just enough demand, prices are pretty sticky. If interest rates stay higher for longer, the people that have to eventually move, that are just feeling trapped in their house or stuck in their house, as time goes on, they will eventually have to move, and there will be more and more people needing to exchange that low interest rate for a higher interest rate, and that will eventually drive prices down in the housing market. So again, if we see higher rates for longer, I do think eventually we will see that housing market and real estate market start to backpedal and prices start to come down. So what's the solution? If you're in that situation, maybe feeling stuck or maybe thinking, yeah, I mean, this house can fit for us right now, but at some point we're gonna need to move, right? We're in a 3-bedroom house and we're going to have another child, or we're hoping to have another child, or we're still in this 5-bedroom house and we're empty nesters. We're not, at some point we're gonna move, or so we want the ranch style house, whatever. So what do? Do you just wait? You just wait and say, well, rates will come back down and that's when I'll figure it out. No, I would tell you, build cash. Work with your certified financial planner. Ensure that you've got the right goals and you're funding them, but at least for this specific risk or potential consequence, build cash. Right now, you can build cash, and therefore, when it is time to move, whether interest rates have come back down or they stayed higher for longer, you've got more cash and you'll need to borrow less. And the double benefit is along the way, that cash will earn a higher interest rate than it would have out there in the past. So this is you flipping the script, and instead of having high rates be a negative, as they would be and when you're borrowing, have it turn into a positive because you're building cash and you're earning a higher rate on there. So you're essentially, while you're waiting to see if rates do come down and gosh, I'm just holding on until we need to make a housing decision, you're building cash and therefore protecting yourself or saving yourself that potential 7.5%, 8%, whatever it is, mortgage out there in the future. Second take, if rates stay higher for longer, the bond market continues to struggle. The bond market continues to struggle. And guys, as we stand right now, in 2021, the overall bond index was negative, so had a negative year. 2022 was an awful year in the bond market, the worst on record for the bond market, and at one point, down nearly 20%. And where I stand at this juncture, while we're recording this, the bond market is negative year to date for 2023. That'd be the first time if we ended the year like this, where the bond market was negative in 2023 as well. It'd be the first time ever that the bond market was negative 3 years in a row. That includes going back to the Great Depression. But there's a relationship between interest rate and bond investments, bond values. As interest rates come down, bond investments go up. And that's why for 40 years, up until just recently, your bond investments not only felt safe, but they were accretive. They were adding value to your overall portfolio beyond just what the interest rate was. But that teeter-totter works both ways. As interest rates go up, bond values, bond investments go down. Done a lot of videos on this, basically explaining the relationship and how this works, and also saying, hey, bonds, unless that company goes bankrupt, bonds will mature at par value at that $100, and right now they're being valued below that. But along the way, if interest rates stay higher for longer, your bond investments are not going to improve. In fact, they could get a little worse if interest rates continue to go up. So what's the solution to that? I've done a lot of videos on alternatives to bonds. You could hold more cash. You could do an individual bond ladder. You could lock in some fixed interest rates at these higher levels. You could even hedge away some risk if you're using bonds not for income but just to manage risk. You could hedge away risk. There's lots of other options. They're not ideal, they're not fantastic, and maybe they're not even long term. But right now, where your lower risk bonds are very high, very risky, looking at some other options might be a good approach if interest rates stay higher for longer. And then finally, guys, the final consequence of interest rates potentially staying higher for longer, I could have started with this one. It's the one that we're all thinking of, and that is that economic slowdown, that recession that many people expected, and now we think, well, oh gosh, we avoided it. No, we didn't avoid it, we delayed it. Ultimately, higher interest rates, and we're not going to get into all the opinions and semantics on it. Higher interest rates takes money out of consumption and has it go towards a non-producing economic instrument. Okay, so yeah, okay, it's paying interest. Okay, yeah, but it's not adding to consumption. If you're having to pay more for your interest rate on your mortgage, that means that money is not there to be spent at Walmart or on Amazon or on the next iPhone or whatever. If you're paying a higher interest expense, that means that money cannot go out and be consumed or be spent. in the economy. That ultimately, even though right now companies appear to be increasing their expectations for earnings out there in the future, if we have higher interest rates for longer, it will be a drag on the overall economy, and that recession won't have been avoided, it will have been delayed. There's a take out there that suggests, well, the reason we haven't seen that recession, even though interest rates have gone up so significantly, is it's not just consumers that have locked in these really low interest rates for a long time and they're not budging off of them. Businesses did that as well. Savvy businesses said, well, projecting out into the future, it's possible we're going to need some cash, so let's borrow while these rates are low so that if rates go up in the future, we're not going to be impacted by that. Lots of businesses have done that, but if rates stay higher for longer, eventually a new need will come up. Eventually a business will need to expand. Eventually they'll need to borrow on their line of credit at these higher interest rates, and that will be a drag on the overall economy. So what's the solution? The solution is to make sure that your financial house is in order. A recession is an overall economic slowdown, leads to higher unemployment rates, leads to challenging and volatility in the stock market, and could impact you personally as well. So make sure you're prepared. That doesn't mean stuffing the pantries and doing, some extreme measures, but it does mean make sure that your emergency fund is fully funded. Make sure that you don't have too much debt. In fact, don't have a lot of consumer debt, that you've been paying that down. Make sure that you know where you stand in regards to your overall financial goals, and that you're managing those and saving towards those appropriately. And when it comes to your kind of long-term investments, make sure that you're not taking too much risk, that you're taking the right level of risk for your financial situation. So not a popular opinion that rates stay higher for longer. I think it's possible. That's not my base case. That's not what I'm forecasting. We don't do forecasting here, but it is possible. And if that were to happen, what do you need to be prepared for? What should you be preparing for right now? Work with your certified financial planner on that. If you don't have a CFP on your team, contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.